But, you know, you have market makers and people who, you know, maybe work at Goldman or work at Chase or whatever, that they're being tasked with filling 1,000 contracts. Well, that's different. I can't just hit the market button with 1,000 contracts unless I'm trading the S&P. So if I'm going to be building a position, I have to do it carefully, right? You know, and the one thing you have to keep in mind is that market makers are paid a premium based on where they're getting in, or the people who work there. So as an example, if your boss tells you, hey, I need you to buy 800 contracts of crude oil with an average price of $66.50, right? $66.50. So if you know that you have to buy 1,000 contracts at $66.50 as the average, that means that anything below this, you're going to be making bonuses on. So what are they going to do? Well, they're sure as hell not going to dump everything on the market, because that's just going to make it spike up. And the market maker, the human behind the orders, or the machine behind the orders in some cases, they're not going to be making any bonus money, right? Well, guess what? Humans are greedy, and we like bonus money. So because of that, they're not going to dump everything on them. They're going to buy, you know, maybe, well, we're going to open up, you know, and they'll come in and they'll say, okay, you know, I'm going to buy, you know, maybe 10 here, get 10 more here. Starts going up a little bit, so ease off the gas pedal, comes back by 10, by 10, by 10, starts popping. Okay, hold off a little bit, right? Buy a little bit more, buy some more. It's coming back up again. No, hold off a little bit, pulling back. Okay, buy a little more, right? And by this point, they've probably averaged into maybe 300 contracts or so, right? And you get this push down to a new low, they buy a little bit more, then we get a big spike down to a new low. That's where they start eating some of those stops, right? When there's a bunch of stops below a major swing, if you have to build in, what better place? You're going to have a boatload of people who sell you a bunch of contracts that you're buying, right? And you can get away with going bigger because it doesn't stand out anymore. It's a stop run. There's going to be a lot of orders that hit the tape. So they could probably get in with a good, you know, 200 more contracts down here. So at this point now they've got about 500. They see this giant spike up and they're thinking, okay, you know, let's see what happens. And it starts pulling higher. Okay, now they're getting a little bit worse on the average because it's getting closer. They have to keep it under this, but because they've built in so many here, they can still afford to get in up here because the average entry will still be below 66.50. So when you have a situation like that, they'll buy a little more and then it pops up above it. Not a big deal, you know, starts pulling back. Oh, cool. You know, now I can buy in a little bit more. Now you know why it bounced here, right? Because it just went back underneath it. Now, I don't know if 66.50 was a level, but you get the idea. Goes back underneath, so they build in more, pops back up. Yeah, no, it pulls back, maybe add a little bit more. Boom, this thing hammers up through the highs. Oh, crap, right? It starts pulling back. Now I got to get in because I got to get my average. And you see this flood of buying volume on people who are chasing the move, but you also have the market makers who haven't built their full position yet. So they're forced to come in so they can get their average and keep it at 66.50. Now, luckily in this case, they actually built in quite a few underneath the low, so they have a situation where even if they were averaging it up here, it's not going to do much because their average is still going to be sub 66.50, probably at like 66.30s. Okay, so then they go to their boss and say, hey, you wanted me to buy it at 66.50? I averaged in and I got everything at 66.30. Give me my 20 cents a bonus, right? Well, 20 cents a bonus on 1,000 contracts and say, you know, whatever percentage that is, they could walk away with 20 grand, no problem. You know, that's small. I mean, they, depending on how big the order is, they could make a huge premium if they're able to scale in enough. So it has nothing to do with the market. It has everything to do with the market maker that's trying to build a position underneath a level and trying to get their average right. Because they don't care what the market's going to do. They could care less, right? The market go up, down, whatever. As long as they get their average in the right place and they make their bonus money, that's all they care about. Now, that's why when you see, you know, an area of interest and a big buyer steps in and you're in a really strong bull trend, and you have a client that comes in and says, hey, I need you to average in 800 contracts below 67. Well, I wasn't told this until here. You know, so it's like, well, crap, how am I supposed to do that? You know, if I'm going to make a bonus on this, I've got to get this thing down. It hits down and they just start hammering the bids. And then you end up getting this big trap that pops back up because they have to get as much as they can underneath that low before it starts going up. And it rocket ships to the upside because they hammered the ask to the point where it just went flying higher. But they had to, because the only way they're going to get their average in the right place, because it's going to start going against them, is to get as many contracts as you can down here. Because when it starts going up, then you can average in and just keep buying, so that your average is roughly around that place, hopefully a little bit under to get that premium. It's all about making money. And remember, they're the ones that are moving the markets.